Ladies and gentlemen, here is a fact of life. Your credit score has become one of the most important numbers in your life, along with your Social Security number. Please pay close attention as Steve clarifies what constitutes a good versus bad credit score and how you can manage it.
When I was a young man, my first encounter with banking began with a passbook savings account, as I've discussed. Now, that's not something that's often used today. In fact, most banks don't even like these small, unprofitable accounts. My second encounter was with a new device called an automated teller machine. As banks go, these were initially free because they reduced the cost to the bank of the teller's salaries. Now, of course, the ATMs have become their own profit center. My third encounter came shortly after my 18th birthday with the receipt of my first credit card. Wow, what a cool device. Instant cash. That money went to buy college books, pizzas from Domino's, and everything else we need. So guess what? Within no time, the credit card was at its limit, and here I was again, broke. Well, then I got my second credit card. This was even better. Because our first card had to be paid, I could pay it off with the second card, which gave me a bigger credit line. Before I know it, I could have 5 or 10 credit cards and total credit limits of $25,000 or even $50,000. Well, this was the beginning of the credit craze. Well, what caused this? Well, there are a number of factors that came together, but certainly one of those driving forces was the standardization of a credit score provided by the Fair Isaac Company. This score, known as the FICO score, was a method of analysis that put the probabilities of creditor problems onto individuals. Thus, a lender, say a bank or a car loan company or a mortgage company, could instantly see how creditworthy you were and therefore set your credit limits, your interest rates, and all of the other terms of the loan. Prior to the year 2000, this credit score was a secret device, not known to the outside world and strictly guarded by the industry. The logic of the lenders was quite simple. If we tell people what we're looking at, they'll modify their behavior to game the system, and they'll increase credit scores even when an increase isn't merited. If you're a lender, you need to know if you can be repaid and what the chances are of not being repaid so you can calculate what interest rate you need to charge to stay in business. Well, in the year 2000, something changed. Something massive that was another sea change brought about by the internet and the information age. A new internet company called eLoan offered to give its customers their credit scores for free. This led to a landslide of public opinion that called for more and more openness on the credit scoring methods, and thus the credit score, known as FICO, became essentially public domain. Before I define FICO for you, though, let's take a moment to determine why this single number is so important for you and your family. Think about your situation as a business. You know, we've discussed that in so many of these sessions. As Chief Financial Officer, your job is not only to invest the retained earnings or savings of yourself, but also to minimize waste in the expense column. As you live your life day to day, you may, for convenience sake or need, use bank credit, car credit, and mortgage credit to sustain the lifestyle you've chosen. But we spoke in earlier sessions about the dangers of this debt, so we'll ignore that for the moment. But let's focus on the cost of these liabilities. You face charges when you borrow money, charges that come in the form of service charges on credit cards, for example. As a very specific example, First Premier credit cards charges up to $7 per month for a credit line of only $300. That's $84 per year for a credit line of around $300. Even if you had your credit card maxed out all the time, that's a whopping 30% rate on that particular card. If you used only $100 of that credit line, the service fee then runs up to an outstanding 84% cost. Okay, so you do want to monitor those direct fees, but what about interest charges? This is where the FICO score comes into play. The FICO score runs from 350 on the low end up to 900, meaning that you and I rate somewhere between those two numbers, the higher the better. At the low end, people are teetering on bankruptcy. On the high end, those are the people who borrow and repay loans with regularity. These numbers fluctuate and change also very regularly based on your activities. But what does it matter to you? Why does this impact you so much? Okay, we discussed the service fees and how large they can be. But how do interest rates change? Well, if you have a high credit score, is your interest rate really better than if you have a low score? The answer is a resounding yes. Your credit score is far more impactful on the interest that you're personally charged than you might think, and the difference can be huge. Here's a trick question. You know the easiest way to save almost $100,000 on your home mortgage? Well, the answer is to have a better FICO score. According to myfico.com, on a $200,000 mortgage, and that, by the way, is the American average, two people having the same job, the same age, the same family and all that, but with one having a 700 credit score and the other having a 625 credit score, they will pay significantly different interest rates. And I mean significantly different. On the $200,000 mortgage, the stronger FICO score will pay total interest of $154,000 over the course of that loan. Now compare that to the person with the lower credit score. They're going to pay $224,000 in interest. That's a $70,000 savings to your income statement over the course of your loan. On a monthly basis, your payment will go from $985 for the higher score up to $1,180 for the lower score. That's a $200 per month savings just for having an improved FICO score. Now, this interest rate differential affects not only your home mortgage, but your car loans and your credit cards. So as you're the CFO charged with managing your expenses, doesn't it just make good sense to reduce the biggest wasted item in your income statement? That's the interest charge. Especially when reducing that charge doesn't have to affect your lifestyle. In fact, it improves because your costs go down. So how do you improve your credit score? Well, first, we have to know what our FICO score is. I don't know if you knew this, but under federal law, you're entitled to receive a free annual copy of your credit report from all three major reporting services. That's Equifax, TransUnion, and Experian. By federal law, these companies must send you your credit report once per year, and that report will show you your credit score and all of the information about you, including outstanding loans, public information, and all that. You should scour this information. Now, look, I know you're busy, and I know the last thing you need is one more job to do. But as the example that I just mentioned points out, simply cleaning up your credit can lead to immediate after-tax income raises of up to $2,500 per year for the average person. That's not chump change. I mean, for the average American, that's a 5% raise for nothing. So you can find the addresses for the three major bureaus on the internet or visit us at stevebeamangroup.com. The second thing to do is to understand how the FICO score is calculated. Now, I'm using the FICO score because it's effectively public domain. There are new scores that are being developed, one specifically called an Advantage score, which is proprietary to the credit bureaus. It's very similar to FICO, so if you learn to manage your FICO score, you'll by default also be managing your Advantage score. Well, what is the FICO score? Well, if you recall how we built multi-factor models in our financial sessions, the FICO score is a multi-factor model. It's based on 5 groups of data and then sub-factors within each of those groups. Here they are. Number 1, payment history. Okay, this is simple. How well do you pay your bills? As you know, your payment history is known by each of your creditors and the reporting agencies. This payment schedule or this payment history comprises 35% of your total FICO score. The second item is amounts owed to creditors. This item looks at your total credit both in the aggregate and as a percentage of your available credit. For example, take two people. Each one has a $1,500 credit card from Visa. Person number one uses $500 of their line, and person number two uses $1,000 of theirs. Well, the first person is using 33% of their available credit, and the second person is using 66% of their credit. So this number is monitored, the logic being that if a person's use of credit increases, it can be indicative of a problem. This part accounts for 30% of your total score. The third item is your length of credit history. This looks simply at how long you've had established credit. If you've had a relationship with American Express for 10 years, that's a stronger indication of stability than if you had one for only 1 year. This is less important than the first two and only accounts for 15% of your total score. The fourth item is new credit. Now again here, this isn't a major item, it's only 10%. But what the model is doing is suggesting that a person who is actively searching for new credit may be a larger financial risk than a person who isn't. After all, if you're financially stable, why would you be looking to borrow more money? Now, the final component, which is also 10%, looks at the type of credit used. As we've discussed, there are different types of credit. A home mortgage is looked at very differently than a Visa card. Likewise, an auto loan is looked at differently than a home mortgage. The notion here is that a home mortgage isn't as bad a credit type as is an unsecured consumer loan like a Visa card. Now, for each of these components, let's look a little bit deeper. The first, which is the payment history, is actually comprised of 7 sub-factors. These are, number 1, information obtained from creditors on account payment and information of specific types of accounts, such as retail accounts, credit cards, MasterCard and Visa, installment loans, finance company accounts, like if you bought furniture on credit. So that's one of the 7 sub-factors of this first category. The second is information obtained from adverse public records. This would include bankruptcies or judgments against you, lawsuits, liens that might be attached to your home or other assets, and a host of other public information. The third is the time horizon of your delinquencies. The longer you have past due items, the riskier you are. The next is the amount due on delinquent or closed accounts. The more you have, the worse your score. Then we move into time, and that's the time that has passed since you've incurred past due items, bad or negative public records, or collection items. And then the number of past due items on file. This would indicate that you don't want to have an overwhelming number of credit cards. Try to keep that at a reasonable minimum. In fact, in the earlier sessions, we talked about having one basic operational credit card and maybe one for emergencies. And then finally, this looks at the number of accounts paid as agreed. So 35% of your score is predicated on the rating of those 7 items. I don't know off the top of my head what the sub-item percentages are, but for a general idea, I just give them each an equal weight so that they're 1/7 of the total. The second category we've talked about has 6 items, and it accounts for 30% of your total score. So here, let's assume each is 5% or 1/6 of the total. And these 6 items are, how much do you owe on specific types? We've talked about a mortgage is preferable to an unsecured credit card. How many accounts do you have, and how many of these have active balances? Now, this next one's an interesting one. What is the proportion of credit line that you're actually using on your revolving charges? Then, what is the percentage remaining on your installment loans? What's the balance due on your car loan, for example? A low balance here would be preferable. And then, lack of a specific type of balance in some case. In other words, if you have uncategorized debts. Well, the third category contains the length of your credit history, and remember, this accounts for 15% of your total score. These are pretty obvious, I think. First, time since your accounts were opened. Again, remember, if you have a 10-year relationship with Visa, that's better than a 1-year relationship. Now, in addition, time since the accounts were opened by specific type of account. Again, here, is it a home mortgage? Is it a credit card? And finally, time of your account activity. In other words, how recently have you used that credit card? Now, the fourth is this notion of new credit, and it's broken into 5 subgroups. Number 1, the number of recently opened accounts and the proportion of accounts that are recently opened managed by the type of account. So in other words, if you're applying for a Visa card every day, that would look really bad. Now, the second is the number of recent credit inquiries. Now, there are 2 types of inquiries. I'm going to digress a little bit here. You should know this. There's what's known as a hard inquiry, and that's an inquiry made by a company when you apply for credit or things like that. The second is a soft inquiry, and that's when you go in to inquire about your credit score. Well, the soft inquiry doesn't count. So when we look at number of recent credit inquiries, we're only considering the hard inquiries. Now, the next is the time since a recent account opening, again, by type of account. The next is time since you had a credit inquiry. The longer, the better. The final is how you reestablished payment on a positive credit history following any past problems that you've had. And finally, you get 10% of your score from the type of credit you have. And that's the number of, and I'm including in that the presence, prevalence, and all the recent information on the various types of accounts you have. Are they credit cards? Are they mortgages? Are they unsecured loans? What types of credit do you have? So that's it, my friends. That is your FICO score. Now, as we've said, the number one thing to do is to retrieve your score, which is free of charge, from the 3 credit bureaus. Number 2 is to understand what your score is made of. And then the number 3 thing is to think about ways to increase your score. Like many of you, I've had credit cards in the past that I've paid off, and then I've closed those accounts. Well, here's idea number 1. Closing accounts isn't always the best strategy. As you can see from the above ratings, 30% of your credit score is based on how you use your credit and what percentage of your credit is utilized. Therefore, an open credit card that is not used scores higher than no credit card at all. But don't get silly here either. You don't want too many of these things just floating around, because that too will hurt your score. So be prudent. To maximize your score, have a couple of credit cards, but use them sparingly. The second idea is to not go on a hunt for more credit. As we discussed in our session on budgeting, you really should be living within your means anyway, so you don't have a lot of need for consumer credit. I mean, yes, you may need a mortgage to help you get into a house, but you shouldn't need consumer credit to buy clothes, food, medical care, and other perishable items. Always remember, the more times you apply for credit, the worse your credit score gets. So there are a couple of quick ideas to improve your FICO score. Now, for some of you who may be in a real problem, there are credit counseling and credit repair companies that can help you with this. For a fee, they'll work with you to determine where errors exist on your credit reports. And by the way, errors do exist regularly. You know the old adage, bad news travels fast? Well, your credit report is known for having all bad news. But when the bad news is removed from life, it's oftentimes not removed from your credit score. So these firms can help you remove the bad information, accentuate the good information, and thereby improve your FICO score. For many people, it's well worth the cost because, as we showed earlier, even on a $200,000 mortgage, the cost of interest can be $70,000 higher for the person with the poor score. So you want to consider that. So this is an explanation of this very important FICO score and some key ideas on how you can improve your FICO score. Let's remember, go secure your score from the major credit bureaus, evaluate it, and then look to improve it.
The importance of a high credit score cannot be stressed enough. Did you know even a potential employer can check your credit score as another indicator of your being a good employee? So take Steve's advice. Be sparing and prudent with your credit card usage and pay your credit card bills on time. These simple but sometimes hard bits of advice will save you a lot of money and headaches. Here's another subject in our financial library that's been in the news quite a lot lately: tax shelters. As you will now hear, the information Steve will impart is pretty straightforward in terms of options, so please pay close attention.
I want to state at the outset that I believe that we all, you and I both, have a responsibility to live honorably and lawfully, and therefore we should pay the taxes that we're due to pay. Now, this is regardless of what you think about government spending or government programs, but the law is the law, and you don't want to be on the wrong side of it, period. Now, of course, with that said, you shouldn't willingly overpay either. Our tax code, which is thicker than the Bible, exists to incent some behavior and deter other behavior. So we should play by the rules and avoid paying where we're not required to. So this session is going to introduce and discuss ways to legally and righteously shelter your money from the tax man. Be aware, in the 25 years I've spent in the industry, I've seen several supposed tax schemes that blew up. There aren't a lot of free lunches, so don't be taken by an unscrupulous operator who promises massive tax savings in return for a small fee. One other note before we begin. I talk frequently with people, particularly self-employed people, who don't have taxes withheld and as a result end up with balances due either quarterly or at a minimum annually. Once in a while, these people find themselves in a position where they can't pay their taxes. They simply don't have the money. Okay, I've been there too, especially during my divorce when the divorce lawyers managed to have my tax money paid to them. Well, that resulted in liens on my houses and the like. Well, let me tell you, even if you can't pay your taxes, file anyway. Not filing will certainly add penalties on top of the interest you'll incur from not paying, and if the situation warrants it, it can lead to more severe penalties from the IRS, including jail. So don't play games. File your personal company and tax returns even if you don't owe any money, or more importantly, even if you do owe money but can't necessarily pay it. Now, in earlier sessions, we touched on the impact of taxes on both your earnings and your investments. It's quite a bite, and it makes it harder and harder each year for people who come from little or nothing to accumulate money to become independently wealthy. So we need to find ways to pay the 20, 25%, or even 30% that we pay the tax man and pay that to ourselves. These tax avoidance methods are not schemes or anything else. They're ways set up by the government to incent you to put your money into certain things. Okay, I've said that before, but it's important. Tax sheltering is not some fancy thing only for the rich. It's for you and me too. In this session, I'm going to list a number of tax items and talk about them. But you, as your company's CFO, should definitely speak with an accountant to get the most recent information about these things. They do tend to change with each passing session of Congress. And while I have a pretty good handle on them, there may be specific ideas that I'm missing. So check with a certified public accountant. The first and usually largest tax shelter people find is their 401k or other retirement plan. There you go. That's fancy, isn't it? Well, clearly, as we discussed in earlier sessions, Congress has a myriad of reasons to hope that you'll save enough of your hard-earned money to retire without hitting the public up for subsistence. Therefore, the laws affecting retirement plans are especially attractive as it relates to taxes. First, when you contribute money to the qualified retirement plan, you can deduct that directly from your income. So to the tax man, you never earned it, and therefore you owe no taxes on it. This can represent an immediate return on your money of, well, and this depends on your tax rate, but for some, of almost 50%. Remember, you save on federal income tax, state income tax, Social Security tax, and Medicare tax. So if you put $10,000 into a plan, that will save you anywhere from $1,500 to $5,000 in taxes immediately. The trade-off is that you've agreed to save the money and won't withdraw it until you're in your 60s. Well, that's usually okay. This is long-term money. The second benefit of retirement plans is that you accrue the earnings in the plan on a tax-deferred basis. Yes, you'll owe income tax on the gains when you draw it out, but that's potentially way down the road. And since you're accumulating on a pre-tax basis, that 8.5% return you're earning will actually earn 8.5%. The power of compounding makes this the critical difference. Let's look at a one-time investment of $10,000 for a 25-year-old. Accruing on a pre-tax basis at 8.5% until that person is 65, they'd have a pot of over $280,000. If that same person did that after tax, in other words, they paid tax on the gains as they were earned, they would have somewhere between $75,000 and $150,000 depending on their tax bracket, but that's quite a difference no matter how you look at it. So to minimize your current tax hit and maximize your future nest egg, max out your retirement plans. Now, I know some have argued against this because of the potential that these could be nationalized. Well, I'll tell you what. I tend to play government laws as they are, not as they might be. This is akin to wanting to go to the grocery store, but waiting until all the traffic lights are green before you leave the house. You'll never go. If we base all of our investment decisions on what government might do, we'd stagnate. So with today's information being what it is, it's a good idea to save for your own retirement and use the tax code to your best advantage. The second tax shelter you should consider is insurance. We discussed in earlier sessions that you can accrue wealth in an insurance product without paying taxes on your accrued amounts. While you can't deduct deposits into the insurance products, the ability to accrue and postpone the tax bite until the end of the policy makes these vehicles very attractive as well. Take another look at annuities. These are terrific programs that allow you to invest your money, defer your taxes, and they come with some guaranteed income benefit when you reach retirement age. In an age of defined contribution plans, why not consider having an annuity serve as your very own defined benefit plan? Third, Subchapter S corporations and LLCs. These are appropriate for individuals who have their own businesses. The advantage of these is that the owner-operator can take a distribution of earnings rather than W-2 income. This loophole was created to help small businesses avoid the double taxation of corporate dividends. Let me be specific. If you own a share of stock in IBM and the board of directors of IBM votes to pay a dividend to you as a shareholder, That money comes out of after-tax earnings to IBM, and therefore IBM paid income tax on the amount it paid to you. And then you also pay income tax on the dividend. The Subchapter S and the LLCs allow you to make distributions as the earnings of the company grow, because under these corporate structures, your individual earnings are one and the same with the company. The largest savings comes in two forms. You may have a lower tax rate than a C corporation, assuming similar profits. And second, paying a distribution is not subject to Social Security and Medicare taxes, which amount to around 15%. As the Medicare tax now goes all the way up on income, this savings is somewhat limited, but it's still there very much for Social Security. Now, as I understand it, the new healthcare legislation did propose to do away with that. So check on that with your local CPA as the legislation becomes more fully understood. There's another thing you should consider. Incorporating under a Subchapter S or an LLC structure does allow you to deduct legitimate business expenses from your income. For example, if you subscribe to the Wall Street Journal, an individual cannot, in most circumstances, deduct that, but a corporation or an LLC can. This can represent a very nice way to acquire some needed resources for an effective discount of anywhere from 15 to 50%. Now, another idea is college savings plans or 529 plans. These are a great way to put money away for your child's education and accrue earnings tax-free. Most states sponsor these plans, although many require that you use your funds for in-state schools only. So be a little cautious here. Make sure your state allows you to use your money as you'd like, but do consider these. The difference between pre-tax yields and after-tax yields are very, very real. Real estate investments are also a great way to shelter income. Here's the magic of real estate. Let's say you own a home and rent it out for profit. The home is worth $200,000, the mortgage is $150,000, and the rent is $24,000 a year. Now that's a 12% return rate, which is really good, but let's go with it for this illustration. Your monthly income is $2,000, and your interest on the mortgage is $1,000. So you're generating $1,000 per month in taxable income, right? Well, not in this case. You can depreciate the building, but not the land, but yes, the building, and that gives you further tax benefits. Let's say the building is valued at $120,000 and the land at $80,000. Well, the building amortized over, let's say, 20 years would represent a deduction of $6,000 per year. And by the way, there are more creative depreciation methods that make this even more attractive. Now, this isn't a cash flow cost to you, it's a bookkeeping entry. But your income is now reduced from $1,000 a month to $500 a month. This provides you a straight up 50% tax savings because your paper income is reduced, even though your cash flow isn't. In effect, you've generated $6,000 per year in non-taxable income. Oil and gas partnerships and other investments also should be looked at. Now, while this changes over time, there are other investments like oil and gas partnerships that can spin off depreciation charges and therefore shelter your income. But keep something in mind. You no longer can lose more money than you invest and write it off. Your write-off is limited to the amount of your investment. That's a big change from years ago. You used to be able to invest, say, $1,000 in an oil well, and then if it lost money, you could deduct from your taxes your total share of the expenses on the well. Well, that expense might have been $5,000 per person, let's say. Well, the tax savings on $5,000 is worth more than the $1,000 invested, so many people played this game. Now realize that's not allowable anymore, so don't be sold one of these touting these unlimited tax losses. Now further, you can look at municipal bonds. In earlier sessions, we spoke about the tax advantages of municipal bonds. In many cases, these can be triple tax-free, meaning that they're exempt from federal, state, and local taxes. Some bonds are double tax-free, meaning they're federal and state exempt, but still, these have the bulk of the benefit as most taxes are at the federal level. Limited partnerships are also a vehicle you can use to move taxes around. As the general partner, you can allocate tax liability and income to the limited partners, and therefore you can shift taxable income to the limited partners who might otherwise have other tax write-offs. Limited partnerships can also provide asset protection when they're properly structured. Now here's an interesting one. Let's move into the world of options. While most options, and we spoke about those in the investment section, while most financial options expire short of a year, which puts their gains into ordinary income, there are options called LEAPs, which are long-term options that expire after 12 months. These can generate, under certain circumstances, long-term capital gains, which are clearly tax-preferred. Another one is unit investment trust. Again, we've discussed these in earlier sessions, and the fact that they generally mature in 13 months after their formation, that fact puts them into long-term capital gains, which again are taxed preferably to short-term gains, which are taxed as regular income. Trusts are one last form of tax management strategy. Trusts assign ownership to a third party who may be in a lower tax bracket. Trusts can transfer title to things also to avoid estate taxes. So if grandma and grandpa have assets they've built over their lifetime, talk with an attorney and consider placing those assets in trust for benefit of the grandkids. It's called a generation skipping trust, and it may avoid federal estate taxation, which comes back in after 2010. Now let's move into some non-investment tax shelters. The most common here is your home. Because the government wants to incent people to buy their homes rather than rent them, you can deduct two big items on your home: the interest you pay up to a $1 million mortgage limit, and the property taxes, which can be very significant in some areas. Let's assume you pay $1,000 per month on your mortgage, which would be approximately the payment on a $200,000 mortgage with an 8.5% interest rate. Well, as we've discussed, the bulk of this, especially early on, is interest. And since you can deduct that, you effectively pay a lower interest rate. In this case, for the average taxpayer, you'd be below a 7.5% effective rate. This is a big incentive to buy a house. Now, there is talk about further reducing the mortgage interest deduction, but this will be targeted at those who earn more than $250,000 and mortgages that exceed $750,000. So those are the major tax shelters you can employ. I'm sorry, folks, there's no magic here. There's just not. Tax laws that had so many loopholes in the 1970s have largely been buttoned up. Now, of course, maximum tax rates have also dropped from 90% to 35%, but tax planning is still important. And as you think about your role and responsibility as the CFO of your own life, be sensitive to the immediate benefits and the benefits that accrue to your investment accounts through being smart on your taxes.
Steve has explained several ways for you, your own CFO, to save on taxes, and all legally. But remember to plan carefully, and don't be fooled by schemes that promise riches, but says you pay no tax. These programs are probably not legal, so buyer beware.